Target Corporation stock, one of the largest US retailers with a dividend increase of 53 years in a row. But is Target also undervalued in stock price, and is it possible that this stock will go up in the coming months? And how about the future dividends? Let's find out. In this video I will show you everything you need to know about Target Corporation stock. I will show you what Target does, and I will show you my fundamental analysis to see if Target is a buy or not. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, Target Corporation is an American big box department store chain headquartered in Minneapolis, Minnesota. It is the 8th largest retailer in the US and component of the S&P 500 index. So, the first thing I want to show you is the share of retail sales of the leading retailers in the US and international sales. We see some big names here, but most interesting is that almost every company is also operating outside of the US, while Target is only focusing in the US. In here we see the number of Target stores by state in the US. California is by far the biggest, followed by Texas and Florida. The total amount of stores is growing every year, which is a good thing in general. This means they are willing to increase the market share by opening new stores. In 2016, Target was sitting at 1800 stores, and right now they are above the 900 stores. So that's a good thing. It is the easiest way to grow revenue. Just open a new store. But it's also very dangerous when a company is only growing because of opening new stores. So a very important thing here is that you also want to grow because of more people go to the same store or because people are spending more money per visit. In this graph we see that in the past years the comparable store sales growth was growing on an average of 2 to 3%. But in 2020 it jumped all the way up to 90%. This is of course related to the coronavirus. And to be honest, the 3% in the years before doesn't feel like much. So, a lot of growth in revenue comes by opening new stores. This could be dangerous, especially when there's not a lot of new spots available. Next up are the 2021 highlights. Target claims to have a 12.7% comparable sales on top of the 90% we saw a second ago in 2020. On top of that, there was also a 11% growth in stores' comparable sales. Digital comparable sales grew by 21% and the EPS is sitting at $14, a 63% increase versus 2020. Target claims to have a 35% growth in revenue versus 2019 and $13 billion in owned brand sales, which were up 18%. Next to that, a double-digit comparable sales growth across all 5 core categories, which we discussed before. On top of that, there was a 54% growth in the same day services on top of the 235% in 2020. There was also a 70% increase in drive up and on top of the 600% increase in 2020. And coming in 2022 to the drive up is Starbucks, which is a nice thing in my opinion. So, another great thing is that Target has opened 100 Ulta Beauty centers, most recently, and plan to open another 250 in 2022. They also have 4 new owned brands across multi-category assortments and have deepened the relationship with leading national brand partners such as Apple, Disney, Levi's and Ulta Beauty. The last thing which I like to mention is that Target is planning to open 32 new stores and has invested in more than 100 existing stores from end-to-end remodels to new spaces. So, there was quite a list with highlights, but for me it's very important to know what a company has done and is planning to do in the coming months or years. The next thing I want to check is the historical stock price performance. If we check the 5-year chart, we see that in 2020 the stock fell down because of the coronavirus, of course. Since then, it climbed all the way up to the all-time high, an increase of 180% in stock price. Since late 2021, the stock is falling down because of several reasons and not so much because of the fundamentals, but all the things that are happening in the stock market in general. If we check the year-to-date chart, we see that the stock is down 6.5%, which isn't a lot compared to some other stocks, especially if we check the S&P 500 year-to-date, which is down 5.6%. So Target doesn't did a bad job year to date. This also tells me that maybe Target is recession proof. Because the stock has come down a lot since late 2021, the fundamentals of this company did change. So, Target is a 100 billion market cap company with a PE ratio of just 15.3 and a forward PE ratio of 14.8. The price to sales is sitting at 1, which is okay in my opinion for this type of company. Target has a profit margin of just 6.5% and an operating margin of 8.5%, which is typical in this sector. So it's not something to worry about because competitors have similar profit margins. The management effectiveness is also looking fine in my opinion. Return on assets is sitting at almost 11% and return on equity is almost at 51%. Great numbers. The 12th trailing month revenue is sitting at $106 billion and the quarterly revenue growth is sitting at 9.4%, which is fine by me. If we check the revenue, we see that it's going down and up in small amounts, but in 2020 and in 2021 there was a big jump in revenue. The net income is following the same pattern and the profit margin is at its highest point in the last 10 years right now. The next thing is the EPS, or earnings per share, which is growing at a nice and steady pace, and back in 2010 it was sitting at $3.3. In 2021 it's sitting at $8.6, which is a huge increase. And it's likely to grow even more from here because of the share buyback program, which we will discuss in a moment. But first, let's check the balance sheet. Target has a total cash of almost $6 billion and a total debt of almost $16.4 billion. I think this is fine because they can pay off a big chunk easily. So this comforts me a lot. Another great thing is that when companies are using debt to grow, for Target it means opening new stores, for example. The current ratio is sitting at 0.99, which is also fine by me, especially for this type of company. Operating cash flow is sitting at 8.6 billion and levered free cash flow is sitting at 3.9 billion. For me, it's very important to have an increasing free cash flow because this is used to pay down debt, buy back shares, do acquisitions, opening new stores, redesign existing stores and also to pay dividends. So, if we check the cash flow statement and focus on the top rule, we see that the operating free cash flow did increase in 2021 versus 2020. But in 2022 it has come down to 8.6. This is something to keep an eye on. Maybe this was something incidental, but if this is fundamental, then you want to pay close attention to this number. If we check the dividends paid, we see that it's increasing a bit, which is not a bad thing necessarily. It means dividends are increasing or the company does issue a lot of new shares. But in the case, it's because of increasing dividends. If we check the shares outstanding, we see that it's decreasing a lot, which is a good thing, because this means EPS will go up and your share will become more valuable. The total dividends paid will go down or are easier to increase and most importantly to maintain. If we check the dividend scorecard, we see that Target pays a 1.6% dividend yield or $3.6 annually. The payout ratio is sitting at 23, meaning there's 77% left to invest back into the business, to buy back shares for instance, pay down debt or opening new stores. The 5-year growth rate is sitting at 7.4%, which isn't the highest to be honest, but it has to be said that Target has increased the dividend for 53 years in a row. Overall, I think you have a very solid dividend payer here, but I wouldn't mind if the dividends were grown a bit higher and the payout ratio will also be a bit higher. I think I would love to see the 5-year growth rate sitting at a minimum of 20%. But a very important note here is that if we check the dividend payout history, we see that it has a big increase in 2021, the first quarter. Dividends were going from $0.68 per quarter to $0.9 a quarter, a massive increase if we compare this to the previous years. So, my conclusion is that Target is a very nice and steady company which is even recession proof maybe. But on the other hand, it might be a bit of a boring company, which doesn't have to be a bad thing necessarily. Sometimes boring companies are a great addition to your portfolio for more balance and peace during bad times. I think with opening new stores they are able to grow their revenue, but the same store sales are a bit low in my opinion. The focus on drive up is really nice to see, and I think this is also one of the better things they are doing in terms of improving the quality of the business. The fundamentals of the company look pretty steady. PE ratio is standing at 15, which is a good thing. But to be honest, for companies like this, I wouldn't pay a premium at all. So I don't think they are massively undervalued. I will pay a max of a PE ratio, I think, mostly at 18 or 20. The debt of the company is also looking good, and I'm not that worried at all because of the free cash flow, which let them pay down a lot of debt if needed. Next to that, the free cash flow is also used to buy back a lot of shares, which is a great thing because as an investor you will get a lot of value from here. Dividends are great in terms of sustainability, but in terms of growth it's quite disappointing except the big increase most recently. But I'm not sure if they will keep increasing the dividends in these huge amounts. Overall, I think you cannot go wrong with owning Target. They are nice and steady, and as said before, sometimes it's nice to have a boring company in your portfolio. For now, I don't think I will add shares to my portfolio of Target, because I think there are better companies out there, but I will definitely keep an eye on them and see what happens with the dividends. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.